two quality stocks trading at fair value. This is a video that I haven't done in a while, discussing two amazing companies trading at fair value in what I would call somewhat of an overvalued market. I think there's a lot of overvaluation, a lot of speculation, Dogecoin, and so many different things. But you could still find a lot of value in the market. And I did find two good companies trading at fair value. The first one is a very popular one. A lot of you know the stock. It's going down based on some uncertainties, which I believe they're overblown. The second one is not as well as known as the first one, but I believe the company is solid and it has a bright future. So I really hope you enjoy this video. For the first one, it's Pepsi, and Pepsi is down 10.5% on the month. And you might believe 10.5% isn't a lot. But for a company like Pepsi, it doesn't happen very often. You very rarely see something like Pepsi down 10 or 10.5% on the month. I mean, the stock barely moves 2, 3, 4, maybe 5% max on the month. And now it's down 10.5%. But it's not just Pepsi. Coke is also down a lot. You have companies like Nestle. Nestle is down a lot. Mondelez, which sells Oreo, is a stock I used to own. Amazing company. Mondelez is also down a lot. I believe Hershey's is also down a lot. So all those companies are going down for one main reason. I'm going to talk about it and assess the risks of this reason here in the video. But I'm just going to talk about the range of Pepsi because I talked about this before. It's a very predictable company. So if you're more of a trader, not an investor for the long term, Pepsi normally goes between 162 to 180. Most of the time it trades up in this range, but sometimes we do break down to a lower level, and this is what happened now. It's sitting at 156, and there was many times where Pepsi has bottomed, as you can see, around 156, 155, and this could be the case again. So we're also approaching some kind of a key technical level, if that's what you want to call it. I'm not a technical expert, but many times it bottoms at 155, 56, and then goes back to 180. And maybe this is the same setup, and maybe it's going to happen again. But a lot of you know what Pepsi does. You know the products that Pepsi sells. It's not just about Pepsi or the beverages. 59% of their business comes from snacks, salty snacks, and stuff that aren't really too good for you. Let's just be honest. And this is the main problem with Pepsi, Coke, Mondelez, Hershey's, and so many of them. We have a new administration and we have a new health secretary. And this, health secretary isn't a big fan of a lot of the stuff that Pepsi sells in a lot of those companies. And his main claim is that Pepsi, for example, for Doritos and so many others, they use certain additives or certain ingredients that are banned in other countries. So, for example, they're banned in Europe, they're banned in Canada, but they use them in the United States because maybe it's cheaper or maybe it's a little bit more efficient for their business. And from my understanding, I don't believe the new health secretary is going to ban Coke or Pepsi. I just don't think it's going to happen. He's likely going to be forcing them to use better ingredients in their food, like the ingredients that they use in Europe or in Canada. And this is why those stocks are going down. But in my opinion, the way I think about it is Pepsi is an international company. And if Pepsi is selling Doritos and Cheetos and all those products in Europe where those certain ingredients are banned, they're using something else. So if they're doing it in Europe, if they're doing it in Canada, why can't they do it in the United States? Maybe it will cause somewhat of lower margins in certain products. Maybe it will cause a certain dip in profitability, slight dip in profitability. But they should easily be able to replicate the same things they're doing already in Europe and in Canada to do it in the United States. Yet Pepsi is going down like never before, so much that it's trading at its COVID low multiple. And COVID low, it traded around 18 times earnings. This is where the stock is trading at, 18 times earnings. The lowest it went to is 16.7 and traded as high as 27 times with a mean of 22 times. And today you're buying an amazing high quality company like Pepsi that you don't get to buy at 18 times earnings very often. You get it a few times in the last 10-year period. And now you're getting it again. You only got it twice. This is the third time. And it's just absolutely insane. And maybe some of those risks are warranted. But the main problem is we don't know exactly what's going to happen. And the market hates uncertainty. That's why those stocks are going down. This is what I'm assuming. I'm assuming he's likely going to force them to use different ingredients. And if he does, then they're going to have to use whatever they use in Europe or in Canada. They're going to have to use it in the United States. And I'm not worried about Pepsi because they're already doing that. So they should easily be able to do it in the United States. But we don't know for sure what's going to happen, the kind of regulations. And that's why Pepsi is going down. But if it keeps going lower, I mean, it would be getting too cheap to ignore, where a lot of that stuff is likely priced in. But you're not only getting this company at a massive discount to its mean multiple, 18 times versus 22 times, but you're also getting a decent dividend. The dividend right now is 3.5%. The highest you had over the last 10 years was 3.8%, and now you're getting around 3.5%. And this dividend has been active for 52 years, and they grow it at a 7.7% CAGR. So you're not only getting a multiple expansion, you're getting a decent dividend, 3.5%, that's growing 7.7%, and you have a company that's still growing in earnings per share. They grow around 9 to 8%. This is based on their own guidance. For the long term, they expect high single digits in earnings per share growth. And based on the analyst estimates, high single digits is between 8 to 9%. You're getting 8% earnings per share growth. And this is easily achievable because Pepsi keeps on raising prices. They have lower volume, but they keep raising prices. So you're getting an 8% earnings per share growth. You're getting some buybacks with that. You're getting a 3.5% dividend that's growing 7.5%. And you're getting the company at a discount versus its mean multiple of 22 times. You're getting it around 18 times. So for me, looking at the risk reward setup, Pepsi is starting to look extremely attractive over here. I wouldn't say a quality stock at fair value. I would say a quality stock at an undervalued price, especially if it keeps going lower. If it goes to, 16 or 17 times earnings, it would be an insane value proposition. I mean, I would be buying the stock like crazy if we ever get to like 16, 17 times. But even over here at 18 times earnings, it's really not bad at all. And once some of this uncertainty clears up over the next few weeks or months or two, I wouldn't be surprised if Pepsi gets back to 23, 24 times and everything is fine again. It's just an amazing company. And I think Pepsi will be fine. And this was my first pick for today. The second one, which I talked about sometimes, but it's been a while since I discussed it. And this is ATD, which is Alimentation. This one is trading on the Canadian exchange. And I use IBKR to buy Canadian and international stocks. And I have like 4 Canadian stocks. I'm finding a lot of values there. I have the link in the comments if you're interested. But if you don't want to buy it on the Canadian exchange, you could also buy it on OTC. As the ticker is ACNTF, I believe. I could put it up on the screen. So it's also available on OTC in dollar terms. And the stock is down barely 1% on the year. It's been volatile. It went up a lot. Then it's coming back down. And there's a lot of different things with this one. But ATD is a convenience store chains. Maybe you saw a lot of the Circle K gas stations or Circle K convenience stores. This is a brand that ATD actually owns, Circle K, and they have over 16,803 convenience stores all over the world, in the United States, Canada, Europe, so many different places. And the company was able to do so well. It's one of the best performing stocks of all time. It's up like 16,700% for just a convenience store company. And the main ways they were able to do it is by doing very smart acquisitions. The company was very smart doing acquisitions. They acquired Total Energies assets in Europe. They acquired car washes and they merged them with the gas stations. Very smart stuff. And they acquired other gas stations and other different things and they merged them together. So they're very smart with acquisitions and they earn high returns on invested capital. And they reinvest in the companies, they do buybacks, they do dividends, they do more acquisitions. And this is how they were able to be one of the best performing stocks of all time that very few people actually knew about. But one of their latest proposal for an acquisition, and it's a very exciting one, and it's 7-Eleven. I'm sure you know 7-Eleven. They're trying to acquire 7-Eleven. The first time it failed, they rejected the offer. Now they raised the offer to acquire 7&I, which is 7-Eleven, for $47 billion, which is 20% higher than their previous offer. The previous offer was $14.86. Their current offer is $18.19. And they're trying to do their best to acquire 7-Eleven. Now, I'm not sure if this is going to work out, but if they were ever able to acquire 7-Eleven and merge those businesses together, it's going to be a monopoly. I mean, it's just going to be an amazing company, very dominant in the convenience store space. You merge Circle K and 7-Eleven. It's going to be insane. Insane value proposition, insane growth. And the company, they said they can finance it through debt. They have good credit rating. They can finance it through debt. So we're unlikely to see massive share dilution or anything crazy. But this is if they were able to buy 7-Eleven. And let's say 7-Eleven, if they did accept, they still have to bypass the antitrust stuff in the United States, antitrust monopoly stuff in Europe, which is very strict, and in so many different countries. So it's not an easy one, especially if you're just combining, such amazing companies, 7-Eleven and Circle K. I don't think it's gonna pass with the regulators and they're gonna say it's a monopoly, but maybe it could. If it ever did, it's gonna be an amazing value proposition. It's gonna be like the best company ever. But if it didn't, the company is still fine. So that's for ATD. And a lot of people believe this business model is dead over the long term because of EVs and stuff. But it's not really dead in the United States. But in terms of Europe, where EVs have been, growing rapidly in market share, Circle K has been installing a lot of EV chargers on their gas stations. And they have like 3.7 million users that just charge their EVs at Circle K's EV stations. So it's not really a dead business model. It's been working very well for them in Europe. And I'm sure they can integrate it in other parts of the world. For the company right now, it's trading at 18 times earnings. The mean is 17.5. So this is one that's not as discounted as Pepsi, but you could say it's somewhat kind of a quality stock trading at fair value. I'm not seeing a multiple expansion from here, but I'm also not seeing a multiple contraction. So assuming no change in the multiple, the company's goal is to return 15% return on capital employed, ROCE, over the next 5, 6, 7 years. Actually, over the next 10 years. In April 2024, they were able to return 13.3% return on capital employed, but their main goal is 15% over the next 3 years minimum. And if you watch Terry Space, he would tell you that a company's return will likely mirror the return on capital employed. So if they are targeting 13 to 15%, I would expect ATD's returns to be closer to 13 to 15%. And if that didn't happen, the company has been growing in earnings per share. They had a tough period on comps over the last, you could say, year and a half, but it's been getting better. It's expected to jump to 12% next year, up to 15% by 2027. So worst case scenario, I would say 10, 12% annual return. Best case scenario, 13 to 15% based on the return, capital employed, excluding those 7-Eleven acquisitions. And maybe they're not overpaying because this management is very smart and they have demonstrated it many times doing acquisitions. So I wouldn't be surprised if, they know what they're doing with 7-Eleven. And if it does work out, it's likely going to be a huge success. And this is all I had to say about ATD and Pepsi, not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.